Paul, I think a lot of people know what venture capital is, but what is venture debt?
Venture debt is a tool that one can use, CEO, CFO, and a board of a company to help extend the cash horizon of their equity base to go further to create more value. So it's a loan essentially that has to be paid back, but it's usually a loan that acts as a surrogate for additional equity to give a company 6 or 12 months more cash runway to create more value, more revenue, or an FDA approval, anything like that.
Okay, that makes sense. And so a company, maybe earlier stage, Series A, Series B, what's the right timing for them to be looking at venture debt?
There's really no right or wrong, but if you were to say, what's my ideal timing for that? The ideal timing would be after you raise fresh equity. So let's say you raised, let's look at two cases. Series A, you raised $10 million. Then somewhere on the heels of that raise, within say 3 to 6 months, is a good time to contemplate the venture debt. That doesn't mean the misnomer is you have to draw it all day one. You're going to get the best terms when the diligence is fresh from the equity raise and when you have a robust balance sheet. You can defer draw part of that, which is a little trick that we recommend people look at. Like, in other words, get an approval for, say, $5 million of debt on a $10 million raise, which is about the ballpark you could do. Similarly, in a later stage company, let's say a company, a digital therapeutics or a connected medical device company has raised a large Series C of 50 million, you can take as much as 25 or 30 million on that, and that really extends your cash runway. So the best time is really within 6 months of a fresh capital raise, just because they know the venture debt lender can diligence the investors that invested, they can diligence the company because it's all fresh diligence, and they have some comfort that fresh capital is coming into the company.
Okay, that makes sense. And what's the process like when a company wants to go raise venture debt?
Well, it depends on whether they do it on their own or with an advisor, but it's a similar process. Basically, you identify the subset of lenders. There's probably 100 lenders out there in the universe that do anywhere from Series A financing on venture debt all the way through profitable public companies that aren't yet EBITDA positive. So identifying the subset of lenders that would invest in a particular situation, and then executing on the process. So you would identify them. You would determine upfront what your strategy is, how much venture debt you would want to see, what kind of covenants you're willing to have, what kind of economics you're looking for, and then you would go out and execute.
Okay. And what do typical terms look like? Like, how long is the loan? What are typical interest rates? What else is associated with the loan?
Again, that's a broad spectrum. We've seen deals in the mid-single digits for bank type financing and venture debt, which is excellent economics. If you're going to do a more exotic structure, your rate's going to be a little bit higher, your economics, but you're also going to it's going to be a surrogate for equity. So if you think of it as I'm creating massive value for my company, but I'm paying, say, 8 to 12% for a non-bank lender or even a bank, some banks, to get that financing done, then it's worth it. So we've seen economics anywhere from the single digits into the double digits. And on the terms, the most important thing that we recommend is looking at how much cash does it actually add to your runway. And there's certain ways to do that. A longer term, obviously, you have to pay it back slower over time helps. And also the interest only period, how long you're only paying the interest payments is important. And most companies can get between 6 and 12 months and longer on interest only payments. And later stage companies can sometimes get 36 months of interest only payments.
Okay. And what is the typical length of one of these loans?
Anywhere between 3 and 5 years. We've seen loans as long as 6 and 7, but the typical loan is probably 4 to 5 years in terms of payback.
Okay. So if I'm thinking earlier stage company, Series A, Series B, like the rules of thumb sound like you're probably going to raise about 30 to 50% on top of what you raised in equity.
Yep.
You're probably looking at maybe 8 to 12% on interest rate ballpark.
Yep.
It sounds like 3 to 5 years, maybe the earlier, the shorter, right? The Series A maybe is closer to 3 years, right?
Yep.
And then you're trying to push for 6 to 12 months of cash extension to kind of hold you over to the next round of equity. Does that sound about right?
That's a great summation. That's exactly right. Again, we always jokingly say, don't build a bridge to nowhere. One of the things we recommend is, hey, we're happy to work with anybody just as a friend without a formally, and that's what a good advisor should do is give you some advice to say, now's the time or now's not the time. If it is a time, then go do the process, go get it done, get a commitment. That doesn't mean you have to draw it all. And there's times where it doesn't make sense to take on venture debt. And a lot of times we'll advise a company, why don't you wait until you raise additional capital until you've done a few other things with the business.
Yeah. Well, Paul, I know I wouldn't raise venture debt without an advisor, and I know that your firm is an excellent one. So I'll let people kind of see a link to your profile and to your company on the notes. But thank you so much for taking the time to walk some of the people in my community around that.
Yeah, thank you. Thanks for your time.